Hello and welcome to Swag Academy. In this video I will make an in-depth stock fundamental analysis of the company JD.com. I will cover its history, business model, growth, balance sheet, profitability and valuation. JD.com was founded in 1998 by Liu Qiandong. Its headquarters is in Beijing, China. The company has a $38 billion market cap. Its stock is trading around $25 at the time I'm making this video. JD.com is a Chinese e-commerce company headquartered in Beijing. It is, in other words, the Amazon of China. It is the second largest e-commerce firm in China after Alibaba. JD is in the business of selling popular household items and electronic devices to Chinese consumers through its online retail platform. JD.com's main source of revenue is the online retail business. The company also generates revenue through the advertising and logistics services it renders to third-party vendors on its marketplace. JD.com acquires product from suppliers and sells them directly to customers. JD operates a network of 210 warehouses across China with total floor space of more than 4 million quarter meters. The warehouse facilities are helping JD.com to hold more stock and diversify its retail offering. Additionally, they provide a great way for the company to improve the order delivery speed. Similar to Alibaba, JD.com also allows third-party merchants and brands to buy advertisement space on its e-commerce platform. JD has invested in high-tech and AI delivery through drones, autonomous technology and robots, and possesses the largest drone delivery system, infrastructure, and capability in the world. It has recently started testing robotic delivery services and building drone delivery airports, as well as operating driverless delivery by unveiling its first autonomous truck. Apart from fulfilling its own orders, JD Logistics has also opened its technologies to external customers, helping retailers like Skechers optimize their logistic operations. JD is competing within China with Alibaba and Pinduoduo. JD grew its revenue from $11.4 billion in 2013 to $150 billion in 2022. The orange line in the chart represents the revenue growth year over year. As you can see, the growth declined from 30% in 2021 to 0.4% in 2022. This is due to the recession we are currently facing, high interest rates and inflation. The same reduction can be seen by its competitor Alibaba. JD grew its free cash flow from $394 million in 2013 to $6.2 billion in 2022, a massive increase in cash flow. So JD can be considered as a growth company. Now let's check the profitability of the company. The gross profit is the result of revenue minus the direct cost to create these revenues. The gross profit margin is the result of gross profit divided by the revenue. The gray line in the chart represents the gross profit margin over the years. In 2022, the gross profit margin was 14.1%. This is relatively low compared to its competitor Alibaba, but typical for a retailer. Now let's check the operating profit and the operating profit margin. Operating profit is the net income derived from a company's core operations. It is the amount of money that a company has left after meeting its operation costs, but before paying its taxes. JD operating profits were negative up until 2019. In 2022, they reached $3 billion. What is more interesting is a razor-sharp operating margin of 2%, meaning from $150 billion revenue, only 2% are left as earnings. This is extremely small. However, we see similar numbers with the company Amazon, which has the same business model. Now let's have a quick look at JD's balance sheet. JD has $48 billion in current assets. The current assets are the assets that are liquid and available to the company within 1 year. They include cash and short-term investments. The total current liabilities are the liabilities which the company must pay within 1 year. JD total current liabilities are $35.8 billion. JD total liabilities, including long-term debt, are $43.6 billion. By calculating the current assets minus the current liabilities, JD is left with $12.2 billion cash on its balance sheet, making the balance sheet extremely strong and healthy. JD can use this money to buy back stocks, invest in the company, or to buy another company. The company has $38 billion market cap. By subtracting the $12.2 billion cash, you will be buying the company at $26 billion. Now let's check the efficiency of the company. In other words, analyze the operating costs. The cost for SG&A, which means sales, general and administrative costs, are $21.1 billion. JD managed to decrease these costs from their peak in 2019 by increasing the efficiency of the company. Shareholders shall benefit from these savings in the future. Now let's jump to valuations. JD has a 0.27 price to sales ratio, a 13.55 PE ratio, a very cheap 5.59 price to free cash flow ratio, and a 1.31 price to book ratio. Pause the video and check how the current ratios compares to the previous years. Now let's do a discounted cash flow analysis to determine the fair price and intrinsic value of the stock. This is how my model works. I calculate the worst case scenario to determine the downside, a normal case and best case scenario. The first column represents the growth rate for the next 5 years. The second column represents the growth rate for the 5 years afterward. The third column represents the terminal multiple, or the PE multiple at which the stock will be sold in 10 years. The fourth column represents the discount rate, or the rate of return the stock will grow over the years. Considering a conservative 10% growth for the first 5 years, a 7% for the 5 years afterward, a terminal multiple of 11 and a 15% discount rate, the intrinsic value of the stock is $49.3. JD is trading at $25 currently, giving the stock a 50% margin of safety. JD is a fast-growing company. The e-commerce is expected to grow worldwide as well as in China, and JD will profit from this growth. However, JD is facing competition from Alibaba and Pinduoduo. They have razor-thin margins and are facing Chinese regulation risk and crackdown. Finally, the 3M analysis. 1M for moat, 1M for management, and 1M for margin of safety. JD has a strong moat. It is continuing to build its nationwide logistics network, which will offer a huge competitive advantage. JD has more than 1,500 warehouses and more than 31 million square meters in gross floor area and more than 300,000 delivery personnel. A new company will not be able to compete with that. A newcomer must invest billions of dollars and years to build such a network. The management did an amazing job growing the company thus far. The founder is a CEO, which is something I really like to see since his goals will be aligned with the goals of other shareholders. JD is trading at a 50% discount from its intrinsic value and has a strong balance sheet allowing it to survive recessions and headwinds. In conclusion, JD is a great company with a great future. I currently have JD in my portfolio. At a 50% margin of safety, I definitely recommend buying the stock.